Welcome to part 2 of how pensions are treated by the taxman. If you missed the first part, click the link on the screen now to watch that first part. There are a number of tax advantages and pitfalls when it comes to saving for retirement. And in this video, I'm going to try and explain to you the next 5 of the 10 top things you should know about pensions tax for retirement planning. I have more detailed videos about some of these top 10 tips, so you'll see links on the video as we go through. So let's go straight in with number 6. Watch out for the money purchase annual allowance. If you're planning to access your pensions flexibly, you need to think carefully about both the tax impact and the effect it will have on your ability to make contributions in the future. Under the current rules, which were introduced to stop recycling of money through pensions, making a flexible withdrawal from your retirement pot beyond the 25% tax-free lump sum triggers the money purchase annual allowance. This permanently cuts your annual allowance from £40,000 to just £4,000. You'll also lose the privilege to carry forward unused allowances from previous tax years. The 7th tip is how to reclaim overpaid tax on pension freedom withdrawals. When you take a flexible payment from your pension, HMRC assumes it's just the first of 12 monthly withdrawals. In other words, you plan to take the same amount every month. This means it's likely to be taxed at an emergency tax rate and will probably mean you can be heavily overtaxed. You can get this money back through your self-assessment tax return or by applying to HMRC. And I've put a link in the description below so you can go straight to that. Number 8, beware the high income child benefit tax charge. If you or your partner has claimed child benefit or one of you earns more than £50,000 a year, you are liable for the high income child benefit tax charge. This needs to be paid through self-assessment, and the more you earn, the higher the charge. And above £60,000 salary or earnings, it equals the total amount of the child benefit. So in other words, if you earn between £50,000 and £60,000, you're still eligible to claim some of the child benefit. But above £60,000, you're not eligible at all for child benefit, so it's best not to claim. The sensible option is to register for child benefit, but opt to not receive it, so you don't have to pay the tax charge, but you still accumulate national insurance credits. The charge could also be avoided by using salary sacrifice to take your gross earnings below the £50,000 threshold. One of the easiest to do tax tips I've got for you is number 9, nominate a beneficiary. Pensions are an important part of tax and inheritance tax planning. And if you die before 75 or age 75, your fund can be passed on to a beneficiary, you name, tax-free. If you die after 75, it is taxed in the same way as income, but can still be inherited by a beneficiary. If your beneficiary dies before age 75, they too can pass on any untouched funds tax-free. Even if the original benefactor, that could be you, the person whose pension they inherited, died after age 75. But you have to nominate who you want to receive your death benefits, otherwise your beneficiaries would only be able to receive your pension benefits as a lump sum. This could lead to quite a significant tax charge for your loved ones if anything happens to you after the age of 75. Nominating a pension beneficiary is usually something that can be done in a matter of seconds online if the pension company give you that access, or can just be done by a form that they can provide. It can result in a massive tax saving for your beneficiaries. And finally, coming in at number 10, did you know that you can claim tax relief as a non-taxpayer? I mean, it might sound a little nuts, but non-taxpayers can get pension tax relief. This includes maybe a spouse who isn't employed, who can still pay into a pension and receive 20% tax relief. The maximum a non-taxpayer can contribute to a pension each year is £3,600 gross. That's after the tax relief. So it's made up of a personal contribution of £2,880 and then HMRC contributing £720. Be aware that the basic rate tax relief, of course, is reducing from 20 to 19% in April 24, which means tax relief on pension contributions will also reduce. This means you'll have to contribute £2,916 to reach the maximum allowance of £3,600, as the government will only be giving you £684 worth of tax relief. Thank you for checking out my YouTube channel. I'm Justin King. I'm a chartered and certified financial planner, and my aim is to help you have a successful life. And my experience, that often involves understanding your money. I hope you have enjoyed this video. If you have, please press the like button to help more people like you find my channel. For now, I'm Justin King, helping you live your best life.